If you're waiting for the silver or gold bottom, you need to see this warning. Because right now, something unusual is happening in the bond market. Yields just hit levels not seen in almost 20 years, and normally, that would be crushing gold. But it isn't. Gold is holding its ground, refusing to break. That single contradiction could be the biggest signal of the year. Get the timing wrong here, and you either buy the top of a false rally or miss the real turning point completely. Stay with this, because by the end, you'll know exactly which scenario is unfolding. Welcome back to Currency Arc Insight, the channel built for serious investors who track the economy before the headlines catch up. If this is your first time here, subscribe and turn on notifications, because the next major shift in gold and silver won't wait for permission. Drop a comment and tell us which country you're watching from today. This audience spans the entire globe. Every trader watching the gold market this month is asking the same question. Is this the bottom, or is this just a pause before one more drop? For weeks, gold has been digging in around the $4,000 mark. It slipped below that level only once on a single closing day, and every other session it has held firm. To the untrained eye, that might look like nothing more than sideways movement. But to anyone who studies market structure closely, this kind of stubborn holding pattern often means something bigger is building underneath the surface. Here is what makes this moment unusual. Over the past week, real interest rates climbed to new highs. Nominal yields did the same, moving higher across nearly every maturity. The 2-year yield pushed upward, the 10-year yield followed, and the 30-year yield closed at its highest weekly level in almost 2 decades, a level not seen since 2007. Under normal conditions, this would be a serious problem for gold. Rising real yields make non-yielding assets like gold less attractive, since investors can earn more by simply holding bonds. Rising nominal yields, especially on the short end, tend to pull capital away from precious metals as well. Historically, this combination has been enough to send gold sharply lower. But that is not what happened. Gold held its ground. It refused to break down in the way the textbook would predict. And this disconnect between rising yields and a stabilizing gold price is exactly the kind of signal that serious investors pay close attention to, because markets rarely behave this way without a reason. There's a pattern worth understanding here. At major turning points, gold tends to move before yields do, not after. It does not wait for confirmation. It does not wait for the Federal Reserve to announce a decision. Instead, gold often begins shifting direction while yields are still climbing, almost as if it is pricing in a future that has not yet been officially confirmed by policymakers. This has happened before. In previous cycles, gold actually bottomed before the 2-year yield reached its own peak. The metal moved first. The rest of the market followed later. If that same relationship is playing out again right now, then the fact that gold is holding steady while yields push to fresh highs is not a small detail. It could be an early signal that the selling pressure in gold is running out of strength. Adding another layer to this story, a Federal Reserve meeting is approaching. The odds of a rate move are rising, and many in the market now expect action in the coming months, if not immediately. Historically, when gold has been in a corrective phase, it tends to find its floor around the time of the first rate hike in a new cycle, sometimes slightly before that decision is even made public. None of this guarantees an immediate rally. Gold is not confirming a breakout. Understand where gold might be heading? A serious investor cannot just look at today's chart. He has to look backward because markets have a habit of repeating patterns that most people forget the moment they happen. Go back to the last few times the Federal Reserve raised interest rates. Each time, gold followed a strikingly similar script. As the Fed began hiking, gold would dip. Then it would find a bottom. Then it would rebound. This happened again in the following cycle. And it happened once more near the end of that decade, when the pause in rate hikes stretched on so long that many analysts consider it the unofficial start of an entirely new cycle. The pattern held for years. Gold sold off into the hikes, bottomed and recovered. Investors who understood this rhythm were able to buy near the lows and ride the recovery. Those who panicked and sold during the dip usually missed the best part of the move. But something different happened this time. Instead of following the old script from the start, gold surged upward first, driven by a geopolitical shock nobody had priced in. Only after that surge did the Federal Reserve begin its hiking cycle, and only then did gold begin its expected slide, pulling back sharply as rates climbed. In other words, the order of events flipped. The rally came before the correction, not after it. This matters because it changes how the current setup should be read. Even though the Fed has not yet delivered its next rate decision, the market is already behaving as if higher rates are coming. Bond yields are climbing in advance. Gold is adjusting in advance. The metal is not waiting for an official announcement. It is pricing in the future the same way it has at every major turning point in its history. Look closely at where the last major peak in yields occurred and where gold's bottom actually formed. Gold did not bottom at the exact same moment yields peaked. It bottomed 2 to 3 months earlier. Yields kept climbing for a while after gold had already turned. Then, as yields finally topped out and began forming a lower high, gold took off. The metal moved first. The confirmation from the bond market came later. If history is repeating in a similar rhythm now, this creates two realistic paths forward, and any disciplined investor should be tracking both rather than betting everything on just one. In the first scenario, the current base near $4,000 holds. Gold has already absorbed the worst of the selling pressure. Yields eventually roll over, and the metal begins a fresh leg higher, much like it did after previous corrective phases. In the second scenario, gold has not yet finished correcting. One more leg lower is still ahead, potentially echoing the pattern seen during the 2008 financial crisis, when gold found its final low several months after the correction began, not at the first sign of stabilization. Neither scenario can be dismissed. The honest answer is that nobody, no matter how experienced, can know for certain which path is unfolding in real time. What can be known is this: the setup today closely resembles the early stages of previous major bottoms, and those who dismissed those setups in the past because they wanted absolute certainty usually ended up paying much higher prices later. The next question becomes obvious. What is actually driving this cycle underneath the surface beyond just interest rates and Fed policy? The answer lies in a structural problem far bigger than any single rate decision, one that touches the very foundation of the financial system itself. Beneath every headline about interest rates and Fed meetings sits a much bigger story, one that most casual investors never stop to examine. It is the story of debt, and it may be the single most important force shaping the future of gold. The numbers are staggering. Interest payments on government debt are climbing at a pace that outstrips almost every other line item in the federal budget. Net interest costs this year are expected to cross $1 trillion. Gross interest, before accounting for the government's own interest income, is heading toward $1.4 trillion. To put that in perspective, that is money the government must pay out simply to service debt already on the books, before a single dollar goes toward defense, healthcare, infrastructure, or anything else. A useful way to measure the severity of this problem is to compare interest costs against total federal revenue, not just against the size of the economy. Right now, net interest consumes close to 18% of everything the government collects in revenue. Gross interest takes an even larger bite. This is not a minor accounting detail. It is a warning sign that the space available for other government spending is shrinking fast. Here's where the math becomes genuinely alarming. The average interest rate on the national debt currently sits around 3.4%. If that average rate climbs by just one additional percentage point, it adds roughly $400 billion a year in new interest costs. Not new spending on programs, not new investment, simply the cost of paying interest on debt that already exists. If rates continue drifting higher, and that average reaches 4.4%, gross interest payments could approach $2 trillion annually. The share of federal revenue swallowed by interest would climb even further, squeezing every other priority the government has. This is the trap. Higher long-term interest rates are supposed to reflect a healthy, confident economy. But at a certain point, higher rates stop being a sign of strength and start becoming a threat to the government's own ability to function. When interest costs grow faster than revenue, something eventually has to give. History offers a clear precedent for what tends to happen next. In the 1940s, facing a similar debt burden, policymakers did not allow long-term interest rates to rise freely. Instead, they intervened directly in the bond market to hold those rates down, a strategy now known as yield curve control. In practice, this meant printing money to buy bonds and suppress yields artificially. It worked in the narrow sense that it kept borrowing costs manageable, but it came at a cost. It was deeply inflationary, eroding the purchasing power of the currency over time. Many analysts believe a version of this same playbook is waiting in the wings today. If long-term yields keep rising and government interest costs spiral further out of control, policymakers may eventually face the same choice their predecessors faced generations ago: allow rates to rise and risk a fiscal crisis, or intervene and risk stoking inflation. Neither path is comfortable. But the second path, monetary intervention to control rates, has historically been the one governments choose when the alternative looks worse, and that path tends to be extremely favorable for gold. This is one of two major structural pillars supporting the case for a continued long-term bull market in gold. The other is the slow, quiet unwinding of confidence in traditional stock market valuations, as investors increasingly search for stores of value outside conventional paper assets. There's a third pillar as well, one that receives far less attention than it deserves. Central banks around the world have been steadily increasing their gold reserves for years. Yet even after this sustained buying, gold still represents a relatively small percentage of total reserves held by many foreign central banks, especially compared to the levels seen decades ago. These institutions are not buying casually. They understand that the global monetary system is likely to change in meaningful ways over the next decade or two, and they are positioning accordingly. Nations without meaningful gold reserves may find themselves at a serious disadvantage when that shift eventually arrives. None of these three forces, the debt spiral, the fading confidence in equities, and central bank accumulation, depend on short-term Fed decisions or weekly yield movements. They are structural. They do not care about this month's headlines, and together they form the foundation beneath everything discussed so far. The reason so many serious investors believe the recent correction is not the end of gold's story, but simply a pause within a much larger one. The next question is where this actually leaves investors right now, in practical terms, with real price levels and real decisions to make. After walking through the yield story, the historical patterns, and the deeper structural forces behind gold, one question remains for every serious investor. What does this actually mean in practical terms, right now, today? Start with the price levels themselves. On the daily charts, gold continues to dig in near the $4,000 mark, the same level discussed throughout this analysis. If the metal can push above roughly $4,200, that breakout could open the door toward $4,400. An area where significant resistance has formed in the past. On the other hand, if this early bottoming pattern fails to hold, gold could drift lower into the $3,700 range sometime around September or October, echoing the slower, more drawn-out bottom seen during the 2008 financial crisis. Silver tells a similar story. If gold manages its rebound scenario, silver has room to climb toward $65 and possibly higher. Resistance sits first near $65 to $67, with a much larger ceiling waiting near $70. These are not arbitrary numbers. They come from years of prior price history, and they give investors real reference points to watch rather than vague hope. Now consider sentiment, because price levels alone rarely tell the full story. Multiple independent sources point in the same direction. Survey data from major financial institutions shows professional money managers holding some of the most pessimistic views on gold seen in over 3 years. Separately, positioning data on major gold funds recently fell to extremely low levels, the kind of reading that, in the past, has appeared just months before significant market bottoms. A third, independent research source shows a similar pattern, sentiment on gold dropping to levels historically associated with major lows rather than major tops. None of these signals guarantee an immediate turnaround, but taken together, they paint a consistent picture. Pessimism is high, positioning is thin, and historically, this combination has marked either the final bottom or the approach to one, not the middle of a runaway decline. There's also the matter of the mining sector, often treated as a leading indicator for the broader metals complex. Breadth measurements, tracking how many mining stocks are trading above their long-term averages, recently fell to levels seen only a handful of times in the past 2 decades. Each prior instance was followed, sometimes with a short delay, by a meaningful multi-month rally across the sector. This does not mean the exact bottom is confirmed today. It does suggest that the broader correction, in the bigger picture, appears to be entering its final stages rather than its early ones. So where does this leave an investor trying to make a real decision, not just watch from the sidelines? The honest answer is that markets never ring a bell at the bottom. There is no announcement, no headline that says the correction is officially over. Those who wait for that kind of certainty typically do not get a better price, they get a worse one. Because by the time the trend is obvious to everyone, much of the move has already happened. What history does offer is a framework, not a guarantee. Elevated real and nominal yields that gold is refusing to fully react to. A historical tendency for gold to lead yields at turning points rather than follow them. A structural debt problem that makes future currency debasement more likely, not less. Deeply pessimistic sentiment readings that have historically aligned with major lows. And a mining sector breadth signal that has rarely been this stretched without a significant rebound following. None of these signals, alone, prove the bottom is in. Together, they describe a moment that closely resembles the earliest stages of previous major turning points, the exact moments when disciplined, patient investors positioned themselves before the recovery became obvious to everyone else. The warning is simple. Waiting for certainty has a cost, and in this market, that cost is usually paid in a higher price.